Imagine this for a moment. Two people walk into the same car dealership on the same day. They both have similar incomes, similar jobs, and they're looking at the exact same vehicle. Yet one person gets approved for a loan with a low interest rate, while the other ends up paying thousands of dollars more over the life of the loan. What caused the difference? It wasn't their salary. It wasn't their savings account. It was their credit score. And what's even more surprising is that many people damage their credit scores without realizing it. These small mistakes can quietly cost you money every single month through higher interest rates, higher insurance premiums, and fewer financial opportunities. Today, we're going to uncover the most common credit score mistakes that may be draining your wallet and what you can do to avoid them. One of the biggest mistakes people make is missing a payment, even by a few days. Payment history is the single largest factor in your FICO score, accounting for a significant portion of how lenders evaluate your creditworthiness. Many consumers assume that one late payment won't matter, but once a payment is reported as late, it can stay on your credit report for years. A single missed payment can cause a noticeable drop in your score and make lenders view you as a higher-risk borrower. The result is often higher interest rates on future loans and credit cards. Setting up automatic payments or reminders can help ensure that this simple mistake never turns into an expensive problem. Another costly mistake is carrying high balances on your credit cards. Many people believe that as long as they make their minimum payments, everything is fine. But credit scoring models pay close attention to your credit utilization ratio, which measures how much of your available credit you're using. If you have a credit card with a $10,000 limit and you're carrying a $9,000 balance, lenders see that as a warning sign, even if you've never missed a payment. High utilization can significantly lower your score. Financial experts often recommend keeping utilization below 30%, and many high scorers keep it below 10% whenever possible. A mistake that surprises many people is closing old credit card accounts. It may seem responsible to close a card you no longer use, but doing so can sometimes hurt your score. Older accounts contribute to the length of your credit history. Applying for too many credit accounts in a short period of time is another common error. Every time you apply for a new credit card, auto loan, or personal loan, a hard inquiry may appear on your credit report. One inquiry typically has a small impact, but multiple inquiries within a short time frame can signal financial stress to lenders. This can lower your score and make future approvals more difficult. Before applying for new credit, it's important to ask whether you truly need it and whether the potential benefit outweighs the temporary impact on your score. Many consumers also make the mistake of ignoring their credit reports altogether. Credit reports can contain errors, and those errors can be costly. Incorrect late payments, outdated account information, or accounts that don't belong to you can drag down your score unfairly. The good news is that federal law allows consumers to review their credit reports and dispute inaccuracies. Regularly checking your reports can help you catch mistakes before they become expensive obstacles when applying for a mortgage, car loan, or other financial products. Another hidden danger is becoming a co-signer without fully understanding the risks. When you co-sign a loan, you're not simply helping someone qualify. You're accepting legal responsibility for that debt. If the primary borrower misses payments or defaults, those negative actions can appear on your credit report as well. Many people damage years of hard work by co-signing for friends or family members who later struggle financially. While helping loved ones can be admirable, it's important to understand that your credit score is also on the line. Perhaps the biggest mistake of all is assuming that credit scores only matter when you need a loan. In reality, your credit score influences many areas of your financial life. It can affect the interest rates you're offered, your ability to rent an apartment, the deposits required for utilities, and sometimes even insurance costs. A strong credit score can save you thousands of dollars over time, while a weak score can quietly increase the cost of everyday life. The good news is that credit scores are not permanent. Every positive financial decision you make today can help strengthen your score tomorrow. Paying bills on time, keeping credit card balances low, maintaining older accounts responsibly, monitoring your credit reports, and avoiding unnecessary applications are all habits that can move your score in the right direction. The difference between a good credit score and a great one may seem small on paper, but in the real world, it can mean keeping thousands of extra dollars in your pocket. Your credit score is more than just a number. It's one of the most powerful financial tools you have. Protect it wisely, and it will reward you for years to come.